a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about ETFs that protect against inflation. Now, inflation is the biggest concern for investors this year, it seems. And in fact, according to Bank of America's latest global fund manager survey, professional investors now see inflation and not COVID as the biggest tail risk for markets. And we saw last week that stocks had plunged after the CPI data. CPI index rose 4.2% for the month of April, and this was much worse than the consensus estimate for an increase of 3.6%. And this was the sharpest increase since September of 2008. So this suggests that the US economy has started overheating, and that is mainly due to accelerating vaccine rollouts and unprecedented monetary and fiscal stimulus that we have seen. And we have already seen lumber prices soaring, copper, iron ore, used auto prices surged 21% in April, and that was mainly due to the chip shortage, which we have seen and talked about. Now, we do not know whether the spike in inflation is temporary or transitory, as the Federal Reserve says, or this is an actual risk for the market, because we have seen low inflation and many false alarms over the past decades. Inflation has remained low for decades, but last year was a very different year because of COVID, and then the stimulus that we saw, and the economy is rebounding very strongly. So we will see whether the inflation risk is real now. But if you are concerned about inflation, it makes sense to add some ETFs or stocks which protect against inflation, which do well in a rising inflation scenario. So one thing you should remember, that inflation is just awful for bonds. Now, popular inflation hedges include tips, gold, other commodities. Now, I do not like tips a lot because they are very expensive currently. In fact, their real yield on tips is negative as of now. And tips are ultimately fixed income instruments, and they are subject to interest rate risk, and they do not do well in a rising rate scenario. They may do better than treasuries if the rise in rates is due to rising inflation, but they do have interest rate risk. Now, gold is typically seen as an inflation hedge, and surprisingly, gold did not do well earlier this year because many younger investors we saw were pivoting to Bitcoin, Ether, and other cryptocurrencies. But over the past few weeks, we have seen that gold has started rising. Other commodities have done very well this year, and stocks that have companies that have real pricing power, that can raise their prices when inflation rises, those do well. So you can invest in commodities directly, or you can also invest in natural resources stock, which may do well. And other companies also which have good pricing power, they will tend to do well in a rising inflation scenario. Companies that have stretched valuations, that are trading on the basis of their expected earnings in 2050 will likely not do well in a rising inflation scenario. So I wanted to highlight three different kind of ETFs that could do well in a rising inflation scenario. So the first one I'm highlighting is by iShares North American Natural Resources ETF, ticker symbol IGNR. So it provides exposure to oil and gas, mining, and forestry companies. And we have seen that all these areas have been doing very well this year because of rising commodity prices, rising inflationary concerns. It follows a market cap weighting methodology, has an expense ratio of 46 basis points and 452 million in assets under management. To learn more about the CTF, you can go to the quote page on Zacks.com, and from there you can go to the external homepage, iShares web page, and see what it holds, what it aims to do. And looking at the holdings, you will see that energy companies, Exxon, Chevron, ConocoPhillips, these are among the top holdings, but you also see other mining companies here, Barrick Gold, Newmont, and if you look at the fact sheet, you will see that it has a lot of exposure to energy, but other commodities too, metals, copper, and other commodities. Now, the second one that I am highlighting, it's actually a new ETF. This launched earlier this year in January, and this is actually one of the most successful launches of this year because it has already gathered 424 million in assets. It's slightly expensive, has an expense ratio of 85 basis points because it is actively managed, and it invests in companies that you will normally not see in your index ETFs. These are inflation beneficiary companies. And again, to learn more about this ETF, you can go to the quote page on Zacks.com. I actually did a podcast on the topic. You can listen to that. And you can go to the external homepage and you will see companies like Texas Pacific Land Corporation, Prairie Sky, Charles River, Franco, Nevada. So these companies, which you will normally not have in your portfolio, you can get through this ETF, and that is why I think it justifies, kind of justifies its higher expense ratio. Now, third one is a commodity ETF. So it uses commodity futures. Now, because of futures, it will have contango risks, and I have talked about contango risks in previous videos, but it does try to minimize contango risk by selecting futures accordingly. It basically invests in energy, precious metals, industrial metals, agricultural, and those kind of commodity futures. This is also slightly expensive, not your plain vanilla ETF, because it invests in commodity futures. It charges 88 basis points, but has been pretty popular with 2.6 billion in assets. Now, again, to learn more, you can go to the quote page on Zacks.com and the Invesco web page for the ETF, and you can look at the portfolios. So you will see crude futures, gasoline futures, copper, aluminum, corn, gold, soybean, sugar, wheat, zinc, natural gas, and silver futures. Now, on the last slide, I have the comparative performance versus the S&P 500. Now, this is since 12th of January, inception of INFL, which I said is a relatively new ETF. So you will see that all three ETFs that we discussed, they have returned between 19% and 21% this year, whereas the S&P 500 index is up about 10%. In full disclosure, I own INFL in the ETF investor portfolio that I manage. Thanks for watching. Make sure to subscribe to our videos so that you do not miss anything. And also make sure to check out Zacks.com/promo for an interesting offer. And I'll see you next week.